From New York City, for our viewers worldwide, I'm Sonali, Basak, and Bloomberg Real Yield starts right now. Coming up, a strong retail sales print pushes back bets on the Fed's next rate cut, as U.S. high-grade credit spreads fall to the tightest levels in decades, with some big names on Wall Street weighing in on the election and the Fed's path forward. But we begin with the big issue: strong data driving up yields.
I think you can still have some confidence that growth is decent.
I think the economy is kind of in a good, solid zone.
We're still in a restrictive environment, so that strength is great.
So if the Fed is truly going to continue to ease and cut rates between now and the end of next year, we're in the soft landing.
These aggressive rate cuts that are priced into the market, how much can the Fed actually do into next year?
Now we're talking about caution on rate cuts. That's huge volatility from a policymaker that is supposed to set guidance.
We believe the market is effectively just like the Fed, is watching every data point.
As economic data has come in better than expected, that's provided a boost to 10-year yields.
This is an environment where yields are very attractive.
You look at the moves that we continue to see in the Treasury market, and it's just very difficult to get off the fence when volatility is this high.
It probably is far more uncertain for bond investors than it is for equity investors.
You just have to manage risk and wait for higher conviction opportunities.
Now, I want to focus right in here on a favorite trade on Wall Street, and that is the steepener. We're looking here at the 210 spread here, and the steepener really did take off, or the uninversion, whatever you want to call it, back in September. But we've seen a lot of volatility since then, and you've actually seen a reinversion of this yield curve, a steepening once again, but not to the levels that we have seen before. So it has not been a simple trade by any means. Let's flip up the board here and look at the rest of the volatility in the bond market as well, honing in on the MOVE index this time, because you could see over a 6-month period, you've actually seen a fairly significant rise in volatility even after that 50 basis point rate cut by the Federal Reserve. And fascinating here, even though you had some volatility at the short end of the curve, certainly you have also had a lot of volatility at the long end, which is why that steepener has been so hard to capture. This week, I caught up with some big names on Wall Street talking about the election, the economy, and how that all feeds into what's ahead for the Fed.
If, in fact, they're wrong and inflation takes off because monetary policy is, in fact, not restrictive and we have fiscal expansion going on and they have to tighten again, I think it could be a nightmare for markets. I'm not predicting it. I'm just saying, why did they go 50 and why do they need this forward guidance?
I think you have a number of investors that are actually just sort of continuing to plow forward on the view that the economy is in pretty good shape and that consumers and corporates are in great shape, so that when there is an election outcome, once there's a sense for whether new policy will actually get affected, then they can have a reaction.
Obviously, a lot of things are said during an election campaign. What actually tends to happen can be different. And so I think investors have to sort of modulate what will ultimately happen versus what's happening right now in the heat of an election.
And joining us now, Meghan Swiber of Bank of America and Nisha Patel of Parametric. Meghan, you take a look at the moves, particularly at the long end. And what do you attribute to most of this volatility?
Sure, Sonali. So it's really been two things. It's been the fact that the data has been so strong. The month of September has been a very strong data flow month. We're seeing that in the retail sales numbers, the jobs numbers. But it's also been the fact that the market is really very focused on trading election, a very big focal point, especially for the back end of the curve, as you mentioned.
Nisha, how do you feel about the election premium baked into the market here? Do you think that the markets have it right with the way the long end particularly has been moving?
Yeah, I mean, look, I think you have an outcome here where the market has been pricing in, certainly kind of from the 360 that we saw not too long ago, a scenario on the economy side that we are not as bad as initially feared. And then to your point on the election, I think we're seeing some of this baked in. But the main thing here, and the biggest hurdle we have to get through over the next few weeks, is the actual election outcome. I think markets haven't fully obviously priced in kind of the extreme scenarios where you have a sweep outcome, and especially if you have a Republican sweep. But in either case, you have pretty, significant spending proposals that are being made here in the face of already, fairly significant deficits and debts that this country is seeing. So I think you're seeing almost a kind of split or a neutral outcome. I do think for bond investors, and let's just say from a bond yield perspective, split Congress is maybe, if you will, kind of the best outcome, just given that you may not see as much extreme spending or more spending. You have a little bit more status quo, downside of which you don't really see significant cuts and changes in the deficits or debt either. But again, I don't think markets have obviously priced in kind of two of the polar sweep scenarios here. And that's something that I think certainly the market is going to be waiting for, and a hurdle that we need to get through.
And I should say it's actually a lack thereof a premium. It's a significant sell-off you really saw in the long end this week. Meghan, when you think about that idea that Nisha was just bringing up, this idea that the polar opposites are not being priced in, what does that mean for the dispersion of outcomes on where things can go in the bond market?
So there is a very fair dispersion of outcomes here. And I think Nisha brings up a really important point here, that sweep versus no sweep matters a lot. We see that when you look at how the markets responded to election outcomes historically. What tends to be most bearish for rates, specifically the long end of the curve, is that sweep outcome. And that's because the party that's in power will tend to be spending more money. This is true for Democrats, Republicans. It's really very important to how the market's going to consider this outcome, is what it means for the fiscal outlook, what it means for supply, and that's why we see the back end feeling that upward pressure. So to us, the more clear way to trade this, rather than purely from duration, what matters a lot for the direction of rates to us is the Fed, the economy. The Fed's still looking to be on this cutting trajectory. The better way to trade this fiscal premium that we see in markets is trading swap spreads. So looking at how cheap we see longer-term cash Treasury yields relative to things like OIS and SOFR.
How do you think about duration, Nisha? Would you buy at these levels, or do you worry that the 10-year yield would be meaningfully higher a year from now?
No, look, I mean, for our clients at Parametric, especially, as we know, there are a lot of clients sitting in very short-term instruments, cash, CDs, money market funds. I mean, we are still going out with the message that this should still be a favorable market for bond investors. And look, I don't think, at least through year end, the Fed necessarily changes course just yet. There is more data that is coming out, from now until the next meeting, another payrolls number, inflation data. But I think if we're assuming that the Fed is still going to want to back to more that neutral rate, more kind of recalibrating rates, I still think you see another 25 basis point cut at each of these meetings. Perhaps the cuts that we're seeing next year might be pared back. But the point being, Sonali, is that for bond investors, this is an opportunity, in our view, to step out of cash and to lock in yields, right? Real yields and inflation-adjusted yields are the highest that we've seen in a very long time. For investors that have been looking for fixed income and allocating to fixed income, I think this is a great opportunity to step out of cash and at least start legging in. Now, from a duration standpoint, I think this is where, you play a little bit of the short to intermediate part of the curve. I do think that, especially as we wait to see election results, you could see more volatility on the long end of the curve. Perhaps this is not a scenario where you go kind of extreme long duration, if you will, but this is still a great time to step out at least a few years and lock in what we think is very attractive yields right now.
Now, going back to the front end of the curve a little bit as well, because that's what's reacting more firmly to the economic data, and you've seen some really strong data. You saw the retail sales data this week. Meghan, how believable is this data? I mean, at what point does it start to turn?
So that's a great question here, Sonali. I think a lot of investors who have been long themselves are asking very similar questions. Look, we've been in a very similar camp as what Nisha was mentioning, saying that now is a really good opportunity for investors to be extending duration. I think a really important consideration here too, Sonali, is what the landing zone looks like for the Fed. Is the Fed going to stop cutting when rates are at 4%, when overnight rates are at 4%, or is the Fed going to be looking to get back to what they view as that more neutral policy rate, 3%? That 3% landing zone is really what we view mostly as our base case scenario at Bank of America. We're still looking at the fact that unemployment is going to be ticking up modestly. We have it peaking at around 4.5% by the middle of next year. And we think that this is still an environment where the inflation data has shown enough progress that the Fed should be cutting to at least 4% and then thinking about delivering perhaps a quarterly cadence of rate cuts starting next year.
Right. So to that end, and only a minute left here for both of you, for you, what do you think, Meghan, how many rate cuts do we get this year, does that mean?
Our house view is that we get 2 more 25 basis point cuts this year.
Nisha, how about you? Do you think we get 2 more? The market is pricing in less than 1 for November.
We do. Again, markets tend to swing pretty drastically in either direction after each data point, but I still think that we're on path for 2 more 25 basis points each through year end.
Meghan Swiber, Bank of America, and Nisha Patel of Parametric. Of course, we are at a very interesting juncture in this cutting cycle and a lot of money on the line. Now, up next, the auction block. We told you last week that the big U.S. banks would have a rush of issuance, and of course, they did. The details on that next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Real Yield. And it's time now for the auction block, where there was a flood of issuance from the big Wall Street banks. Financial firms made up all of this week's 7 issuers, and all the deals were at least $1 billion in size. JP Morgan, Morgan Stanley, and Goldman lead the way to a nearly $26 billion total. And I want to dig deeper into those bank sales as positive earnings report helped to drive investor strong demand. For example, JP Morgan's sale drew about $34 billion in orders and caused it to increase the final deal size. And over in high yield, more financials, Jane Street Group sold a $1.15 billion junk bond and is repricing a $3.2 billion loan. The firm is raising additional capital for trading as the firm pushes further into fixed income. All about bonds. Speaking of credit, BlackRock's Russ Kosterich sees upside ahead for corporate bonds.
Very long spread products in the fund, high yield, investment grade securitized. And the notion there is, in that 40% of the sort of a traditional 60-40 portfolio for the first time in years, you can actually get a decent 6 to 7% yield, get that tailwind from carry.
Joining us now, Meghan Robson, head of U.S. credit at BNP Paribas, and Lotfi Karoui, chief credit strategist at Goldman Sachs. And guys, I want to flag now that we're seeing an average spread on a U.S. investment grade bond narrowing to the highest level in 2005. There's super tight spreads here. You can see it in the chart. We've been talking about this all year, and in fact, the spreads are even tighter than they were in the middle of the year. Meghan, I don't get this trade. Why are investors accepting such low of a premium on this trade?
Well, to Russ's point there, despite spreads being extremely tight, you do have yield levels which are still elevated. So I think that a lot of the demand for yield has really pushed us into these frothier spread levels. And despite the supply in fins we saw this week, corporate supply has actually slowed down. So I think there has been a more scarcity of bonds that has pushed the spreads tighter, in addition to, of course, a higher probability of a soft landing. Growth data continues to surprise positively, and you also have Fed dovishness, which I think is supporting the market here.
Lotfi, what do you think about that? I love that word frothy because it's like one step away from bubble. How do you feel about where we stand today and how much money has been flowing into the corporate bond market at really the expense of some returns?
Yeah, no, I agree. There's a yield conversation, there's a spread conversation. The spread conversation is uninspiring, to say the least. But we went from historically tight levels to all-time tight levels, and so we're literally stuck in a valuation conundrum here. If you look at the asset class from an all-in yield standpoint, then I would argue that the value proposition is okay, without being spectacular. But take high yield as an example. You get paid 7% all-in yield. If you compare that, quite frankly, even to the equity market, it's not a bad value proposition. But to your question, I'm very comfortable with the economic backdrop, the durability of the cycle. but valuation from a spread standpoint is increasingly a concern.
You know, Meghan, what's going to cause supply to pick up once again? Because you saw that first 50 basis point rate cut, and you have to wonder with the maturity walls that you might see in the next year, the next couple of years, how much might issuers wait to see rates fall much more meaningfully?
I think it will be very rates dependent how much more supply we see. In the near term, many corporates are still in earnings blackout, so October seasonally tends to be a lower supply month. And I think also you have this election risk that issuers are trying to avoid. So I think October will still be a light supply. Following the election, if yields land where they are now, you may start to see corporates pull forward some of that 2025 issuance. On the other hand, if we see yields higher, then I think we could see issuers wait.
You know, it's interesting when you're thinking about that rate cutting cycle, so much uncertainty around it. And Lotfi, if we don't see significant cuts, what does that mean for the maturity walls that are around the corner?
Well, it depends what the reasons are. If we see a shift in the forward path of policy rates because growth is actually holding up a lot better than we think, then I tend to think that that wouldn't have much of an impact. On the other hand, if we're delaying the cuts or we have a shallower easing cycle because of a scenario featuring inflation reacceleration, that would be a risk-off in my view, and that would probably discourage companies from issuing. The one thing I would add, and this has certainly been visible in my conversations with issuers, is that there's broader acknowledgement today that we're settling in higher levels of yields relative to that 2020-2021 period. So expectations have been re-anchored to higher levels of funding costs. And I think we're kind of back to business as usual in terms of volumes, whether you look at IG or high yield.
It's the skepticism in me as a journalist to ask about the pain points here, because you're watching this economy, and yes, the overall data is so strong in so many ways, the retail sales, for example, but you are seeing areas where there are moments of concern. You look at the credit card companies, Amex, high net worth individuals, yet you're still seeing the stock down today. And this all goes to say that, you know, how worried are people about consumer credit? It's really Ally you saw a lot of the pain from. Is this an area that people are avoiding right now, Meghan?
So I think there are certain areas of the consumer where we're seeing weakness and pullback, and I would say just very discretionary categories. So think about aspirational luxury, some of the spirits companies where you've seen really a premiumization of brands, or some of those larger big ticket item purchases, things like boats and pools. We have seen consumer pullback from those areas, but more broadly, I think the aggregate consumer picture has been very strong. So for us, the tail risk is less of a slowdown at this point and more of the risk of a reacceleration and anything that would take that Fed put off of the table.
It's incredible. I'm glad you brought up boats, pools, high-end liquor. I mean, you know, Lotfi, when you look at areas that perhaps could be impacted by the consumer or areas that you might see more signs of weakness at this level of the stage of the economy, you know, where do people start to stay away from certain credits?
I think earnings. I mean, to that, first of all, I would keep a very close eye on that chart because that chart is really fascinating. You have got delinquency rates that are actually close to levels that you see in recessions, and yet the broader economy continues to do well. So good reminder that this cycle is really different. But earnings, in my view, is the number one ingredient that I would keep a very close eye on. 2023 was some kind of a corporate earnings recession, particularly among the mid caps, small caps, and in high yield. You need to get out of that. And so third quarter earnings season, I think, is going to be very informative from that perspective. If we clear that bar, then we're kind of back in an environment where earnings growth will likely exceed whatever growth you're going to see in terms of interest expenses, which would be a bullish scenario. But earnings growth is the number one parameter I would keep an eye on.
I want to marinate on this a little more because the delinquencies chart is stunning, right? And if you think about that spillover effect, I'm wondering how far that really goes. If you were kind of talking through some of the sectors here, but you think about it even in terms of auto loans, right? If people cannot borrow to buy a car or borrow to buy a house, then what does that mean for other sectors of the economy that may be a little stuck?
I think that so far you are seeing, you know, almost the opposite, an easing of financial conditions. So we are expecting rates to come down, which should help improve that picture and continue to see, some potential relief in the delinquencies that you just highlighted there.
And it's interesting, too, I want you to comment a little bit more here, Lotfi, on those specific sectors when it comes to auto and home. I think, yes, the financial conditions easing, rates coming down, it should help people. But at the same time, when it comes to the housing market, it seems to be a long way before there could be a lot of comfort in what that market opens up to be.
Yeah, no, I don't disagree with that. I think the housing market is a bit in a special situation here. Now, the good news is that we're definitely going to put that big shock in affordability behind us. On the other hand, I think the cuts are not going to be a panacea for affordability on a forward basis. Mechanically, mortgage rates are a lot more linked to intermediate and long-dated yields than they are to policy rates. And so for affordability, I think supply still holds the key more so than the direction of Fed policy here. We've made some progress in terms of bringing more inventory into the market, but things remain very tight from a historical standpoint. And our view is that affordability will continue to look challenging, at least by the standards of the last 25 years. And that probably means that, house price appreciation is here to stay, too.
We only have about a minute left, but for each of you, 30 seconds. Meghan, favorite trade at this juncture?
Favorite trade at this juncture is single B loans. So we like, not for upside, but for carry. We think the yield looks attractive, and our thesis of a more shallow rate cut cycle than the market expects should mean that the yields look good for some time into 2025.
Lotfi, what do you like out there? Most conviction?
I have to agree with that. I think, bank loans over high-yield bonds, which is very counterintuitive going into a cutting cycle. But Meghan is right. I think the carry is more attractive on the loan side.
Carry, yield, don't mind the spreads. Meghan Robson of BNP Paribas and Lotfi Karoui of Goldman Sachs. Thank you both so much. Happy Friday. Happy weekend to you. Now, still ahead, the final spread. We're going to talk about the week ahead because earnings season is in full swing. Tesla, Boeing, and much more ahead. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up, the IMF and World Bank annual meetings kick off in Washington, D.C., plus a trio of Fed speakers with Logan, Kashkari, and Schmidt. Tuesday, ECB President Christine Lagarde will be interviewed by Bloomberg's Francine Lacroix. Plus, we get comments from BOE President Andrew Bailey. Earnings from Tesla, Boeing, and Deutsche Bank and the Fed's Beige Book the next day. And then Thursday, global PMIs and U.S. jobless claims and new home sales. Friday, durable goods and the University of Michigan Consumer Sentiment Survey. And for my final thought, we're looking at WIRP on the Bloomberg terminal. This is Fed rate cut expectations. You have a moment here where you're seeing the idea that we might not even get a single basis point rate or a single 25 basis point rate cut in that November meeting. Let's see what we have coming to fruition here. A lot of dispersion, but of course a lot of economic data ahead. From New York, that does it from here. Same time, same place next week. This is Bloomberg Real Yield, and this is Bloomberg.